Hey guys, this is Anurag Sharma, and in this series of understanding major functions of Reserve Bank of India, today I'll be discussing with you qualitative instruments of monetary policy. It is the second part of monetary policy. First one was quantitative instruments, and now it is the qualitative instruments of monetary policy. Now, what are qualitative instruments, guys? Now, qualitative measures are also known as selective instruments. So, it is very self explanatory that these instruments are discriminatory in nature. Unlike quantitative instruments, those are non discriminatory in nature, and these instruments are discriminatory in nature. The basic difference is that whereas that quantitative instruments put impact on all over the economy, but these instruments puts impact on specific products or specific sectors. It regulates and controls credits only to special products or sectors. So that is why these instruments are known as discriminatory in nature and also known as selective instruments. Now, for example, if the government wants to check the rising prices of wheat in India, the Reserve Bank may instruct the members bank not to give loans against the security of wheat. Now, traders will not get any credit for the purchase of wheat, and therefore they will not be able to buy large quantities of wheat. So, this will reduce demand pressure on wheat. Now, this measure would bring down wheat prices only. Guys, note this point, wheat prices only, as the credit squeeze is directed towards wheat alone. So excuse me for spelling mistakes. It is thus called selective control because it is putting impact on a single product, that is wheat. So that is why this instrument is known as selective control instrument, and BR in 1949 has conferred upon the Reserve Bank of India many rights of selective credit control. Now, these are the various techniques and instruments of selective credit control. Now, number one is change in margin requirement of loans, moral suasion, direct action, and capital rationing. Let's discuss these points one by one. First one is change in margin requirements of loans. So first of all, question arises, what is margin requirement? Guys, we can understand this margin requirement with a simple example. Suppose if you want a loan, suppose amounting rupees 1 lakh, and say margin requirement is set for 20%. So that commercial bank will give you only 80% of the money, that is 80% of 1 lakh is 80,000. So bank will give you 80,000 rupees only, and the rest remaining amount 20,000, that amount you have to arrange here by yourself. So this margin requirement is the basically difference between loan value and market value of the security. So margin requirement is different for different types of loans, and for priority sectors where RBI wants to give more credit. What is priority sector? Agriculture, small and medium enterprises are known as priority sector, and RBI wants to give more credit to these sector, this priority sector. So there in those sector margin requirement will be less. So in that particular, so maximum amount, the maximum contribution will be given by the bank. And areas where credit is to be squeezed or contracted, then margin requirement will be increased. So that is how margin requirement takes place. So this is the basic difference between loan value and market value of security. Clear, guys? Now next, qualitative instrument is known as moral suasion. Moral suasion is basically a combination of persuasion and pressure which RBI exerts on all commercial banks. Now how they do it? This is exercised through discussions, letters, speeches, meetings, seminars, and various hints thrown to banks. Now RBI convinces commercial banks to curb loan to unproductive sectors. They will give hint, do not give to loan unproductive sectors, and they can also advise them to extend more credit to priority sector where there is more and more need of credit. And persuasion is used by Reserve Bank to urge banks to keep a large amount, large proportion of their assets in the form of government security, treasury bills, and etc, which are notified by RBI, and not to borrow from the bank when it is engaged in in fighting inflation. RBI is this monetary policy is a basic instrument in fighting inflation. And if they are if commercial banks are borrowing more and more from the bank, the bank means central bank, then they do not, they cannot control, that money supply efficiently. So this persuasion technique is also used by Reserve Bank, so that these commercial banks use their assets in form of government securities and treasury banks, and the security is notified by Reserve Bank of India. So they persuade and put pressure on commercial banks, and RBI uses it from time to time by the way of speeches, or any seminar and meetings arranged by Reserve Bank of India with member banks. Now next is direct action. BR in 1949 gives Reserve Bank to stop any commercial bank from any type of transaction. RBI is the ultimate authority while monitoring the operations of any commercial bank, and central bank may charge penal rate above, over and above the bank rate upon defaulting banks, and it can also stop giving loans and even recommend the closure of the member bank to the central government under pressing circumstances. If circumstances, any defaulter bank commits again and again the same same actions which RBI prohibits, so RBI also recommend the closure of that particular bank to the central government. So this is direct action plan, where RBI is directly interfering with the working of the commercial bank. And the last one is capital rationing, and this technique is used by RBI to put limits on credit to different sectors. Again, because it puts impact on different sector differently, again it comes under the qualitative measures. And RBI fixed credit quotas for different business activities, and commercial banks cannot exceed the quotas limits while giving loans. And capital rationing is introduced to check the speculative activities in the economy. So RBI sets the quotas, and banks cannot exceed those quotas while giving the credit, while giving the loan. So that is how this capital rationing takes place. So this is all about the qualitative instruments, and it also concludes the most important function of the Reserve Bank of India, and that is designing and implementation of monetary policy in our country. And their tools, those tools are divided into two broad categories. One is known as quantitative, which I've already discussed in the previous lesson, and this chapter deals with the qualitative measures. Guys, if you have any doubt, please write down your doubts in comment section. And teaching is a two-way communication. Do not forget to give your valuable feedback and reviews. I'll be waiting for that. This is Anurag Sharma. Happy learning.